Welcome to UPSC Vinoth. So today we are going to see the continuation of monetary policy. See, already I had discussed the video with respect to monetary policy in my channel. So just go and visit the playlist of UPSC Prelims 2026. Okay. So let us have a discussion over continuous discussion over this monetary policy instruments. See, it's very simple. There is only one thing. See, that is money supply. Money supply is a common theme. If money supply increases, then inflation is increasing. If money supply decreases, then inflation will decrease. Now, now under this, some of the instrument is there. See, if there is how the in last video itself, I had discussed how the money supply is getting increased. RBI gives money to commercial bank. Commercial bank lends money to public. So if public fails to repay the money, then what will happen? See, there will be qualitative and quantitative measures. First of all, let us discuss only qualitative measures. See, it is moral suasion. See, like persuasion and communication techniques to influence bankers' behavior. Communication drive, advisory guidelines, goal and alignment, non-coercive. And qualitative instrument measures are to control direct and allocation of credit to specific sectors for the economy rather than treat that overall money supply. See, they will plan to lend the money those who are able to return the money. So direct credit control, regulation of the credit flows to specific sectors or industries, as I told you. So forward regulation, qualitative limits, goals, non-market based, and selective credit control. Again, same thing in other words. Targeted specific types of loan to control the demand in specific areas. Okay, let us have a model MCQ discussion with respect to this. With reference to qualitative instrument of monetary policy, consider the following statement. See how many of these are correct. See how many of these are correct. See, qualitative measures. Qualitative measures are designed to regulate the total volume, of money supply in the entire economy. See, regulate the total volume of money supply in the regulated. See, qualitative measures is what is qualitative measures. So, instrument to measure to control the direct allocation of credit. It is to control the direct allocation of credit. It is not to regulate the total volume of money supply in the entire economy. See, this is wrong. Moral suasion involves in use of psychological means and informal advisory by central banks to influence the commercial banks lending. See, it is giving advice. Okay, so 2 is correct. Direct credit control refers as administrative order to use to regulate the flow of credit to specific industries. Yes, I told you to give the loan those who are capable to repay. Selective credit control is also same thing. It's primarily used for influence the demand for specific types of the consumer loans and marginal requirement. Here they are used for industries. Here they are used for consumers. Direct credit, select credit control. Direct credit is specific industries. Select credit control is consumer. So only 3 is correct. Statement 1 is incorrect. Okay. So let us have a monetary policy stance. See, this is very much important. See how in what stand the RBI takes in the means of monetary policy. See, it's very important. First all, there is a 4 monetary policy stance. What is the 4 monetary policy stance? Dovish stand, hawkish stand, accommodative stand, neutral stand. Dovish, hawkish, accommodative, neutral. See what is meant by dovish stand. The central bank reduces the interest rate. See, central bank reduces the interest rate or maintains the low rate of environment to stimulate the economy. See, that is dovish is something. They are low interest rate. Low interest rate, high borrowing. High borrowing, development of the economy. Dove, dovish rate. Hawkish rate is what? So, see, opposite to dove, it is hawk. It's very easy to have idea over this kind of words. Dovish means positive means of a positive aspect, reducing the loan rate so that you can, so that what? So that economy can grow. Hawkish means central bank raises the interest rate to curb the inflation. If there is inflation, central banks, you know that central bank will raise the inflation rate. That is hawkish stand. Even at the cost of slowing down the growth. Even though the growth slows down, they will keep on raising the interest rate. to curb the inflation. Accommodative stand, it is to balance. See, accommodative, central bank keeps the interest rate low and injects the liquidity into the economy to support the growth of employment. See, dovish, accommodative, both are similar, but here low rate environment is maintained at dovish state. But here their central bank keeps the interest rate low and inject liquidity into the economy to support. See, inject the liquidity. This is the keyword. Inject the liquidity. Here also keeps interest rate low. Here also keeps in hard dovish state also they are having the reducing the interest rate, maintain at low environment. But here to inject a liquidity is a keyword in accommodative stand. What is neutral stand? It's very simple. Central bank maintains a balanced approach. That's all. Balanced approach. Now have a now we can have a MCQ with respect to above point. The dovish stand is characterized by, see, it's very easy. See, dovish stand is characterized by reducing the interest rate. Dovish stand is characterized by reducing the interest rate. Okay, to stimulate the economic growth and encourage investment. Yes. Hockey stand is involving raising the interest rate. Reduction in the interest rate, raising the interest rate to curb the inflation. Even if it is results in slowing down the economy is a keyword too. An accommodative stand. An accommodative stand, see, is a stance preferred by strategy where central bank injects liquidity and maintain low rates to support the employment. Again, accommodative stand is correct. A neutral stand implies the central bank has strong bias towards economic expansion over price stability. No. Neutral stand is its balanced approach. See, neutral stand is means central bank either they do not go for pro growth and they also don't go for anti growth. So they will maintain a balance. But here what they are giving as a strong bias towards economic expansion. No. Statement 3 is wrong. Only 3 is correct. Okay. So now coming to the next current affairs keys. Monetary next to monetary policy stand, we do have a monetary policy committee. See, it is very important. We have a monetary policy committee. They decides the inflation rate. They decide inflation rate. First of all, whenever the name committee comes, you should look into that whether it is a statutory body or a constitutional body or whatever it may be. First of all, monetary policy committee is a statutory body. What is their aim? What is their aim? Determine the policy interest rate to achieve the inflation targets. Ultimate aim is money supply is to regulate the inflation. That is money supply into the economy. Again, what statutory monetary policy is what the committee is framed to achieve this aim. So to control the inflation. Constitution under Section 45 is at RBI Act 1934 by Central Government Act. So by this, the Monetary Policy Committee has been formed. What is their primary goal? Price stability while supporting economic growth. They will see this is their aim. Yeah. What is the framework? Flexible inflation fit framework means flexible inflation target framework. That is flexible inflation target framework. Okay, fine. Fine. Okay. So now inflation targets sets at 4%. See, this is the inflation target is up to tolerable. See, we are setting at 4%, but it is total tolerance to 2 to 6%. You should not go more than 2%. You should not go less than 6%. So there are totally 6 members. See, UPSC has asked the previous year question paper. They mentioned 12 members. So that is strong. So 6 members. Chairperson, who is the chairperson of Monetary Policy Committee, Governor of Reserve Bank of India, ex officio. RBI members, Deputy Governor, Monetary Policy, 1 nominee from RBI officer, external members, 3 members appointed from central government for how many years? See, UPSC will twist the keyword here. 4-year term. 4-year term. 4-year term external members. Meetings. At least 4 times in the year. It's very easy. 4 quarters. 4 quarters make 1 year. Quarter, for every quarter they will decide a monetary policy. For every quarter, say what is the quorum. See, they will look for all the members to come for a meeting, but if anyone is missing, that means they will not stop the meeting. The meeting will happen whenever 4 members, if the meeting will happen when the 4 members are they will join. It is called as quorum. Voting, each member has 1 vote. So governor as casting vote. See, this is one of the important point. Governor as casting vote. That means governor don't have normally. Governor will not have a voting power. If the voting, if there is 12-member committee. Sorry, it is a 6-member committee. It is 6-member committee. Whenever the debate is happening, 4-2 means it will go on 4. The 4, if any 3-3, that means governor will enter and the cast is vote. So it will come 4-3. Then automatically the resolution will pass. So this is governor as a casting vote. Okay. Now consider the following statement regarding Monetary Policy Committee. It is a statutory body. Whether it is a statutory body, yes, it is a statutory body. So statement 1 is correct. So see, keep the keep the thing very simple. So it is a statutory body on Reserve Bank of India Act. So RBI Act 1934. Okay, yes. The inflation targets is set by governor of RBI. See, the inflation target is set by governor of RBI. It is set by Monetary Policy Committee, not a whole member. Okay. So the quorum for meeting is 4 members. See, yes. Statement 2 is wrong. Statement 3 is correct. Again, in the event of tie, voting of RBI governor is casting vote. Yes. Only 3 statement. This question is based on previous year question. Flexible inflation targeting framework. Now, I am coming with the another important point, that is flexible inflation targeting, that is targeting framework. That means you are making a framework to make a flexible inflation to counter the flexibility in the inflation. See, first of all, former member of Monetary Policy Committee. So former members means what? Before members, not current members. So they were insisting to go with flexible inflation targeting framework. Flexible inflation targeting framework. Okay, that is 4 plus or minus 2 percentage. See, this allows the central bank to fix the target inflation based considering growth rate, interest rate, exchange rate, output, employment. See, this is the keyword. The inflation target is fixed on inflation target is fixed based on growth, interest rate, exchange rate, output, and employment. Okay, so uh, this is set in every 5 years. Already it's like it is set for every 5 years. Inflation target is set for every 5 years. So origin India, introducing via monetary policy framework between government and RBI. So this is originated in India. That is flexible inflation target is introduced via monetary policy. It is introduced via monetary policy. Operational accountability. So RBI must maintain CPI inflation at 4% with 2 to 6 tolerance. Decision making, Monetary Policy Committee decides policy interest rate implements. See, you know that our decision making is done by Monetary Policy Committee. Breach consequences. If inflation breaches the band of 3 consecutive quarters, RBI must report. See, it is very important key point. Say they are fixing the target every year. But if the target is breached, they should inform they should give a report. RBI must give a report. So report to whom? Ministry of Finance. Report to Union Ministry of Finance, must explain the reason and remedies also. Why inflation target is not achieved, or else what is the reason? Consider the following statement regarding flexible inflation targeting. It is a framework introduced through Monetary Policy Framework Agreement. See the question. See, you, with the help of the question only you can recall all these things. See statement 1. Statement 1 says the framework was introduced through Monetary Policy Framework Agreement between Governor and Reserve Bank of India. See, government and Reserve Bank of India. Yes. Flexible inflation targeting is between whom? Government and Reserve Bank of India. Statement 1 is correct. Under FIT, the principal mandate to target the inflation without considering other macroeconomic. So you should consider with growth or growth, employment, output, exchange rate, all these things. So statement 2 is wrong. The inflation targeting. The inflation target is set by RBI. The inflation target is set by RBI. Government of India. Government of India sets the inflation. Most of the people will go with this correct. No, it is wrong. So it is, see, statement 3 is incorrect. The Government of India sets inflation rate, not the RBI independently. This does not And also this is done with the consultation of RBI. RBI, see, government of India along with RBI, consulting with RBI fixes the inflation target. So statement 3 is incorrect. So failure to maintain the target 3 consecutive quarters, RBI, yes, they are required to submit report to Union Finance Minister. Yes, statement 4 is correct. So only 2 statements are correct. Okay. Next, key banking terminology. This has the more importance. So you have the mainly you can expect a question from here. That is key banking terminologies. That is LTV ratio. What is LTV ratio? Loan to value ratio. Maximum percentage of gold items value that the bank can give loan. See, they will simply ask what is LTV ratio. Define LTV ratio. LTV ratio is a ratio for loan to value. Loan to value. This is the ratio for gold loan. Ultimately, it is for gold loans. Gold loans means maximum percentage of gold item value that bank can give loan. See, if you are see today due to NPA, mostly banks prefer gold loan because gold will be a security for the bank. See, that means bank can't keep on getting the gold. So there is a limit, that is loan to value limit. It is a maximum percentage of gold item value that bank can give as a loan. LTV to India, presently LTV values you can have a 85%. That means for a gold worth of 1 lakh, you can get 85,000 as loan. That is LTV ratio, loan to value ratio. You can't give the value of 1 lakh rupees gold and get 1 lakh rupees loan. You will get up to 85,000 only. 85,000 only. The value is 100. You can borrow up to 85,000 only. See, this is one of the most important thing. What is loan to value? See, this is loan to value. Split the word. See, this is very much important. UPSC will ask that term-based question like this. What is meant by loan to value? It's very, 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 very simple. I'm getting loan according to the value of my mortgage of the gold. If the value is 100%, I will get 85% of it from loan. And coming to net interest margin. Net interest margin refers to difference between interest bank earns on the loan and interest they pay on the deposit. See, it's very simple. Net interest margin is very simple. Generally, bank will get deposits. So they must give interest for the deposits. Interest for the deposits. And bank will lend loan. And they will get interest for the loan. Now you know that always this interest, that means for the interest given for deposit will be always less than interest given for the loan. That means if I get 1% of interest for my deposits, then I will get 2%. I want to pay 2% loan, 2% interest for the loan. That is what? Net interest margin. Earning interest on loans minus paid interest. That is net interest margin. See, lending rate, deposit rate. It's very simple. Okay. But these terms these terms will make you, this looks like strange. Consider the following statement regarding loan to value, net interest margin. Regarding it, the loan to value represents the minimum percentage that an asset value that are borrowed. Loan to value ratios represent the minimum percentage of asset value. Minimum percentage of asset value that borrower must provide as a collateral. See, statement 1 is totally incorrect. They are saying minimum percentage of asset. No. What is LTV ratio? LTV ratio is maximum percentage of an item value. It's not minimum percentage. Maximum percentage of item value. That is 85%. Maximum percentage of item value that financial institution can lend. So for 1 lakh rupee, I can lend up to 85,000 rupees. That is loan to value ratio. Here they would mention minimum percentage of asset value. It is maximum percentage of asset value. If LTV value is 85%, so statement 1 is wrong. if an LTV ratio of 85% implies the borrower can receive up to loan 85,000 rupees. Yes, you know that. Net interest margin is measures of spread difference between interest income earned by the bank and interest expenses paid to the depositors. Yes, you know that statement 3 is correct. And reduction in the repo rate by RBI typically leads to immediate expansion of net interest. See, they use the word immediate. So see, when repo rate falls, bank often lowering the lending rate faster than the deposit rate due to competitive pressure. They will, yes, if the repo rate falls, they will reduce the interest rate for lending, but they won't suddenly decrease the interest rate for deposits. They will wait for some times. They immediately, the word makes this is wrong. Only two. See, it is one of the most important thing you should know about this all these things and all. Again, now coming with the UPSC favorite question, open market operation. What is open market operation? It's very simple. Buying and selling of the first of all, who does open market operation? RBI. RBI does open market operation. RBI sells and buying and selling of government securities. First of all, there is two thing. One, see, RBI, let us assume. See, you won't get this type of easiest discussion nowhere. RBI has government securities. They are the owner of government securities. Whenever the inflation is high, they will sell when inflation is high, they will sell the government securities, and they will observe the inflation. They will, whenever the inflation is low, they will buy the government securities and make money supply more. So this is the rationale behind the open market operation. This is termed as open market operation. RBI selling the government securities to observe the liquidity. There is an excess liquidity in the bank system. GSEC moves from RBI to market, and rupee liquidity moves from market back to RBI. Regulate the overall money supply. Yes, you know. Then liquidity injection. What is meant by liquidity injection? It's very simple. See, it's very, very simple. So RBI purchases government securities to inject the rupee. That's all. That's all. So context, liquidity in the banking system is tight. Rupee liquidity moves from RBI into market. GSEC moves from market to RBI. You know that it is a quantitative monetary policy tool. See, this open market operation is a quantitative monetary policy tool to observe, to control the inflation. Now let us have some discussion with respect to open market operation. Consider the following statement, MCQ's discussion. Consider the following statement with respect to open market operation in Reserve Bank of India. They involved in the purchase and sale of government securities. See, you know that they involved in the purchase and sale of government securities. Statement 1 is correct. And to regulate the liquidity, yes. The sale of security by RBI results in injection of, sale of security. Sells means they will selling. RBI selling the security. That means they will get money. That means RBI will absorb money. That means statement 2 is wrong. The sale of security by RBI results in injection of liquidity into the banking system. No, they will not inject. So statement 2 is wrong. Open market operations are considerably qualitative. See, it is a quantitative. So statement 3 also wrong. These are all the operation direct influence of money supply and interest rate in the economy. Yes, only 2 is correct. Next, understanding the government securities. This is GSEC. See, I was talking about GSEC. What is meant by GSEC? Now, the government securities are tradable debt. First of all, this is tradable debt instrument issued by central or state government. The name itself suggests it is a government security. The name itself suggests it's a government security. So now, it is a tradable debt instrument. It is issued by central or state government. See, both. See, first of all, commonly GSEC is issued by central and state government. It represents the government borrowing. See, G security, whenever the G security is with public, then government has borrowed from the public. Represent the government borrowing and debt obligations to manage durability of durable liquid. It is used by RBI in open market operation for liquidity management. Yes, you know, government will sell the GSEC and absorb the money, and they will buy the GSEC, they will inject the money. Types of GSEC. It's very, 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 very much important. Types of G security. That there are short-term G security, long-term G security. Short-term G security, treasury bills or T-bills. Short-term G security are treasury bills or T-bills. They will say maturity less than 1 year. Maturity of less than 1 year. Short-term security treasury bills, maturity of less than 1 year. It is used for 91 days, 180 days, 364 days. Okay. Then long-term. Government bonds are dated securities. It is known as dated securities. Maturity of 1 year or more. Here less than 1 year, here 1 year or more. Maturity date. This is, they will give the GSEC for short term, and government will give assurance that I will buy within 91 days or else 180 days or 364 days. Now in long term, within 10 years. Maturity within 10 years. Now let us have some MCQ discussion with respect to government securities. The government securities are tradable instruments that represent the debt obligation only for the central government. No, it is for the central government and what? State government. Okay. So here statement 1 is incorrect. The treasury bills are short-term debt instrument with maximum maturity period of 364 days. See, statement 2 is correct. We have 91 days, the maximum maturity. In between 91 days, 182 days, 364 days. State government in India authorized to issue both treasury bond and dated security. See, in this, central government can issue treasury bill. I'm giving right now. I'm giving one more point to you. Central government, that means in India only central government can issue treasury bill. Central government can only issue treasury bill. Okay, state government do not issue treasury bill. Instead of that, they will issue long-term state development loan. Instead of giving treasury bill, the state government will issue long-term state development bond. This is the important keyword here. They can't issue the treasury bill or dated security. It is completely belongs to central government. They can issue law, or then how state can raise the fund? They can issue long-term state development bond. Okay. So statement 3. Dated securities are long-term. Yes, typically they are long-term. Yes, you know, dated securities are long-term. So only 2. Statement 1 is incorrect. Statement 2 is correct. Statement 3 is incorrect. Statement 4 is correct. Now, we are coming up with other important concept called dollar rupee swap. Dollar rupee swap. What is this? The dollar rupee swap is a temporary exchange of currency between RBI and bank. It is temporary exchange of currencies occur between RBI and commercial bank. See, it is not between countries. Whenever you feel that the dollar rupee swap means it will happen between India and USA, it is not like that. RBI, it is take the dollar rupee swap is between RBI and banks. This is the first important keyword you should know about this. This is the first important keyword. That is, it is based on dollar. It is based on what? Dollar rupee swap between RBI and commercial banks. Okay. Step 1. So see here, RBI takes dollar. See, it's very simple. RBI takes dollar from the banks and give them rupee. RBI takes US dollar from the bank and RBI will give equivalent rupee to the banks for a fixed period of time. Then reversal. Transaction reversed after the decided period. Predetermined exchange rates are applied. Now, this measures the rupee liquidity into the domestic system while stimulating absorption of excess dollar liquidity. This also observes the dollar liquidity. See, this is very much important regarding see what is dollar swap. Now injects the rupee liquidity into the domestic system, address the domestic rupee shortage, enhances the banking system, lending capacity, absorb excess dollar liquidity, calms volatile forex market, strategic goals, manages domestic money supply and currency stability simultaneously. Consider the following statement regarding dollar rupee swap. Reserve Bank of India. It involves a temporary exchange of currencies. Whereas RBI provides dollar to the bank in exchange of rupee. Yes, you know that just now we had studied what is dollar rupee swap. Surely they will ask this question 100% because whenever the word dollar rupee swap comes, people will think it is between India and USA or else India and IMF or else India and World Bank. No, it is between commercial banks and India. Okay, it is a temporary exchange. Yes, it is a temporary exchange. It's not permanent. It is have a time period, right? So wait for a second. Statement 1. It involves in temporary exchange of the currency where RBI provides dollar to the bank in exchange of rupees. 1 second. What is dollar? It is temporary exchange of currencies. No. See here. It is not permanent. 1 second. Consider the following statement in auction conducted by dollar to rupee swap auctions conducted by RBI. This is auctions. This talks about auctions. Okay. It involves in temporary exchange of currencies. No. See here, RBI will not provide dollars. RBI will give rupees. So, RBI will absorb the dollar. RBI will not provide the dollar. RBI will absorb the. Let me explain. Already you know that RBI is getting dollar from. RBI will absorb the dollar from commercial banks. So, statement 1 is wrong. The transaction is reversed at predetermined exchange rate after fixed rate tenure. Yes. This instrument is used to inject rupee liquidity. See, yes, this is used to inject the rupee liquidity in domestic banking system without the permanent expansion of monetary base. So statement 3 also correct. A buying selling swap results in stimulation or absorption of excess dollar in the liquidity. Yes, all only 3. You know that statement 1 is incorrect. Now, another important thing. Forward premium. What is meant by forward premium? See, it's very important. What is meant by forward premium and currency market? See, the word forward premium mentions it is simply how much extra you have to pay to buy dollar for future date compared to buying them today. See, it's very simple. You are buying the dollar for today. Spot. It is 83 rupees. You are putting agreement. That is forward premium. How much extra you have to pay? How much extra? That means how much extra you have to pay to buy a dollar for future date, not today. For future, let us consider 1 year. For after 1 year, I want dollar. For that, I am paying today itself. Okay. In future, I want to buy $100. $100. So that I am today the dollar is 83 rupees. But in future, I don't want $100. In future, I want $100. So that it's like what is future? It is future forward premium. Forward premium. What is forward premium? It is I'm going to buy a dollar for future purpose on future purpose on not today's rate. Then the new rate will be fixed, that is 84 rupees. For example, it is 84 rupees plus 1. This is forward premium. How much extra you are paying? Let us say for next 6 months they are saying today the dollar rate is 83 rupees. I want to buy dollar for futuristic purpose for, let us say, for 6 months. Say let us have a, I want to pay extra. How much I want to pay extra? Let us say they are saying 84 rupees. This 1 rupee is extra. This is called forward premium. This is called forward premium. So when too many dollars are available in the market, the forward premium will increase. High forward premium raises the cost of importers and the dollar's demand will increase. See, when the forward premium increases, the dollar demand also increases. Ultimately, dollar price also increases. Ultimately, dollar premium also increases. Forward premium also increases. See, okay. What is spot market and forward market? Currency exchange immediately is called spot market. Immediately the current exchange rate is called spot market. Forward market is in future date. A rate is decided today, transaction completed later. Same thing. Forward premium, forward market. Spot market, spot premium. See, these concepts are can be explained only in this channel. So this is, it's not like something you are not, it is not like something, it is not relevant to the exam. UPSC is always having the tendency to ask the core concepts of RBI. With reference to Indian forex market, foreign exchange market, and role of Reserve Bank of India, consider the following statement. The spot market involves exchange of currency rate at prevailing rate of immediate delivery. See, spot. You know that what is meant by spot exchange rate. It is, they are saying immediate. Yes, the word spot, immediate. Forward market, what is a forward market? A forward market, the exchange rate for future date is locked at the time in the agreement. Yes. An increase in the dollar supply within the domestic market typically leads to decrease in forward premium. No, it will increase the forward premium. An high forward premium increasing the hedging cost for imports and entitles the foreign forex currency denominated debt. Yes, a forward premium increases the hedging cost for importers and the entities with foreign currencies denominated debts. Yes, ultimately only three is correct. Okay, so we had a exhaustive discussion with respect to monetary policy. I'm confident that we will get at least one question from this. I'm more confident. So thank you.